Hello accounts people, time to have a look at non-current asset registers. So we've got a question here from Osborne's practice paper 2. If you can't quite read it, I've blown it up as much as I can for the screen, allowing me to do some work on here. Your AAT tutors should have access to it via the tutor zone. It's a perfectly good question. We're going to fill in the non-current asset register. It looks pretty much the same as most AAT exam ones, and then we'll just have a look at the ledger accounts associated. They're not part of the question, but we can use these numbers to create some ledger accounts. So reading carefully, there are some details that are non-standard in this one. No VAT in this task. We're buying a machine, we would normally claim the VAT back on it if we were VAT registered, and we're disposing of a copier. If we reclaim the VAT back when we bought it, we'd have to charge VAT, or it would be inclusive when we dispose of it. So we bought a HT cutter. It's got its own cost, the machine cost. Delivery charge is fine, we can capitalise that, but this 150 can't be included in the cost. That's a revenue expense, so it would have its own little account. So the actual cost would be 2845. Just what's anything else? Let's have a look. Over 500, that's not a problem for capitalising. Machinery, 25% diminishing or reducing balance. Office equipment, straight line, no scrap value, no residual value. However, instead of having the standard rule of a full year in the year of acquisition, none in the year of disposal, we're calculating on an annual basis and then splitting per month. And the year we're dealing with is the 31st of March to 1, and exactly as it says, we'll deal with acquisitions, disposals, and then depreciation. So acquisitions first. So our acquisition was our new HT cutter, and we bought it on the first day of the financial year 0. And we've already discussed it was 2845 because we can't include the maintenance contract. And we bought it on HP, on the NOC as it used to be called. That's the acquisition. The disposal. So what we're selling is this office equipment. We haven't calculated last year's depreciation yet, but we can put the £200 we got for it in, and we sold it halfway through the year. I have to bear that in mind when we do calculations. Exactly 6 months through the year. So now we're on to our depreciation calculations. At this point we can switch to a bigger view, because I can remember that office equipment is straight line for 5 years, machinery 25% diminishing balance. So we better do this one first. So this is the one we sold partway through the year, so not the standard rule of none in the year of acquisition. Normally it would just be D4 divided by 5, cost divided by 5 because it's 5 years straight line. However, could have divided by 2 really. Divide by 12 times 6 because you owned it for 6 months. This will often be filled in wrong. On the 31st of March, it hadn't got a carrying amount because we'd sold it 6 months earlier. So students often accidentally fill in the carrying amount there, which would be 375. That will matter, that 375 as a carrying amount when we sold it, and we only got 200 for it. So this one, the first year isn't the same again, because that was only for 3 months. It's 240 this year, and then the carrying amount will now be the old carrying amount minus this year's depreciation. And that's our office equipment dealt with in our non-current asset register. Machinery then, that's the one that's a diminishing or reducing balance method. And our depreciation charge for the year is the carrying amount from the previous year, because it's diminishing balance times 25%. It tells us it's 25% in the question. And then carrying amount, the old carrying amount, calculated the same way as a straight line minus the year's depreciation. That's that one dealt with. And then the HT cutter, this is okay, it's a whole year, so we haven't got to worry about a fraction. It's arguable diminishing balance on fractions, because it's a different amount. Should it be more at the start of the year? This one solves the problem. We bought it on the first day of the financial year, presumably because the manager got a budget for the financial year. So the depreciation charge for the year is £711.25. Cost price minus depreciation charge leaves us a carrying amount of 2133.75. We could just divide that into months for most questions, most people would. We haven't got the tick boxes to show barcodes and the fact that we've found it and it hasn't been stolen, it's still in use or been authorised, but this is as it will appear on an AAT screen. So the ledger accounts are using the same numbers. We have, to start off with, depreciation for office equipment. We have two charges for office equipment depreciation. We have the 75 and we've got the 240. And this one, as it's now an expense account and you're now on level 3, to the statement of profit and loss, £315, closed off, no brought down, carried down. The office equipment accumulated depreciation, I'm deleting this by mistake, should have had a brought down of 360, that's up the sheet, and then this is extra 315, but I'm going to leave it there because we've had the disposal to deal with, so we're not going to carry down and brought down yet, because we actually sold our office equipment. So into our disposals account, it was 750 when bought new. That's out of the question. That's the 750 here in our non-current asset register. That's the full cost. So whilst we're at it, whilst we remember, we'll do the double entry for that. So it's the first step: transfer the equipment that is plant and equipment that is being disposed of into the disposals account. One credit, one debit. Step 1 of disposals. Step 2 is to transfer its accumulated depreciation, and its accumulated depreciation at the point of disposal was 150 plus another 150 plus 75, 375. Step 2, transfer the accumulated depreciation into the disposals account. There we are. So its book value was in fact 375, half of that. That can now be bought balanced off. Brought down. Quite too much maths, isn't it? But office equipment at cost. £1,200. Complicated maths. There we are. So we've transferred the office equipment in and its accumulated depreciation into the disposal. So before we finish off the machinery account, we'd actually better finish off our disposals account, because we had £200 in the bank, debit the bank, credit the disposals account, and that of course doesn't balance off because we didn't get as much for it. So we've got a loss on disposal in our statement of profit and loss as an expense account of 175. It was worth 375, but we only got 200 for it, and that is an expense account, so that closes off rather than balances off. So depreciation charge for our machinery then, so this is the one that's okay, a bit intense, but apart from that, to the statement of profit and loss, closing off, and then 5, and then U2, U3. But this one will be carried down because it's increased. But our machinery at cost was 2,800, and we've got an acquisition. We stick it in the sundry payables account because we owe the money on it. We haven't got any more details. That's the 2,845. Sundry payables was used for the credit transaction as well. So whoever we owe the money to doesn't make any difference. Brought down at the start of next year is the old moulder plus our new cutter, and that's dealt with. So we've got a fairly standard, slight change in the rule here, just watch out for that one. This is a full year, it might be part of a year on a different question. Both our types of depreciation tested in the same question. Funding method, you can see actually some others, part exchange, cash, HP, could be credit here as well. We've disposed of an item, we've bought of an item, and we've done the ledger accounts whilst we were at it, and a disposals account.